Ready to rock.
Andy, welcome, mate. And I think the crowd's welcoming us.
Happy Friday,
mate. Made it to another Friday. How you going, mate? Welcome to another Wine and Wisdom. A few little technical hitches there for us to get started today, but we're off and running, so that's good news, mate. Great to see you, buddy. How's your week been? I know both of us have been attending and teaching at a course the last few days, so it's been good to be helping some others. But mate, what's been happening in your neck of the woods in the marketplace? For those who are dialing in for the first time, welcome along. Wine and Wisdom from Andy Fenton and myself, Jason Whitten, and we get a chance each Friday. We talked about this the other day. We started this get together on Fridays. Seems like forever ago, but when the COVID uncertainty arrived on our doorsteps, Andy and I thought we would add value to our communities, our respective communities in the world of finance, financial planning and banking. Andy's history and the marketplace, stock market, etc. 20 odd years in that world. For myself, in the real estate game, mortgage broking, property management, property purchasing, property strategy, 20 odd years as well. So we thought there's a lot of uncertainty out there, and we thought we'd have a little wine and share some wisdom on a Friday evening. And it's kicked on for a little while. So welcome anyone who's dialing in. For those who have dialed in for the first time, welcome. Great to have you here. And how it all rolls, Andy and I sort of wax a bit of lyrical. We usually collect a few articles or a few things we want to share from the week. And often a few of the listeners dial in from wherever they are and they chuck a few questions in the chats as we go along. So if anyone's dialed in so far and they're interested in leaving us a chat message, please do. But Andy, what's going on, mate? What is happening in the world of the stock market out there, my friend?
It's a really good question to start off with, because what I'd pre-planned for this, and we'll offer a little prize, I reckon. So we'll do a little free half-hour consultation with anybody who can pick this. Yeah, it shouldn't be that hard, but maybe it will. So have a look at this. If you can pick this stock, then let us know. Have a look at this for an incredible performer. This makes Elon Musk look just flat out average, and I reckon this is a good one just to leave hanging there, because look at that. That is a 1,571% return from the 28th or the 27th of July to the 29th of July. Not a bad investment, one would say.
Crikey. So, Andy, did you pick that one, brother? Why didn't you let me know about that one?
But I missed the bus on this one. It had well and truly bolted by the time I caught it, and I'm definitely not looking at putting any money into it, because
Brian's made a call, Andy. Brian's listening in all the way from Singapore. Welcome again, Brian. He made a call. He reckons it's Kodak, Andy.
Oh, mate, spot on the money. He just crushes it straight off the bat. Has that been in the normal news? Brian, you've killed the cliffhanger, and we're only 30 seconds in.
There's a cliffhanger. Oh, Brian's in the know, mate. Good work, Brian, mate.
Well, let us know if you want to take us up on the consultation, mate. Happy to do so. But yeah, that's Kodak, mate. That is so Kodak. Remember the company Kodak, which so it used to be the camera company, used to be made obsolete by technology. Yep,
mate.
And then it was made obsolete. Well, so Kodak went through an interesting period of time, and look, obviously we all know Kodak from obviously missing the mark when it came to digital cameras.
Oh, hang on, Andy.
Digital cameras.
Hang on, Andy. This one's for you, Brian. This one's for you. Well done.
Incredible work, mate. You have got one hell of a crowd sitting behind there, and they're so obedient. Next time I'm giving a presentation, I want that crowd, mate. That's unbelievable. So here's to the crowd. So, mate, Kodak has gone through a very, very interesting well, adulthood, really, because it was the dominant player in the market as in photography, and then moved into, then missed the boat in digital photography. Said digital photography won't take off. Kind of like those people who said, nah, faxes are the way to go. Email, nah, it's just a fad. So Kodak basically just sort of slowly disappeared over time, became redundant. And then they had a bit of a crack at being a Bitcoin style trading company. Then they went into some other type of semi-tech company. And obviously, and if we just have a look at this share price, right? If we have a look at really what happened beforehand, let's see if I can actually annotate this. Oh no, I'm in the.
I think you're
in the wrong
photos,
section,
aren't you? Yeah.
But I am in photos, but so I won't annotate it. But you can see the tail of it doesn't really do much for a long period of time, and that was pretty much, well, actually it fell pretty much as aggressively as it took off. But it re-engineered itself a few times, and then guess what? Just have a guess, mate. If you haven't been watching the news, guess what they're doing now?
That's a big guess, mate. I don't know. No, fill me in. I don't watch the news, as you know. So current affairs, as I rely on people like you to fill me in on the important stuff, Andy.
Well, the company's valuation jumped from 52 million to 1.5 billion as the shares actually as the shares took off. Absolutely took off, and it's on the back of the company securing a loan from one of our favourite little Oompa Loompas, who is one of the lunatic controllers of the free world at the moment, Mr. Trump, gave the company a secured $765 million loan.
Does he own shares? He probably bought shares in it before.
Mate, I'd venture to say that there might be a couple of relatives somewhere around the traps that may have some sort of vested interest.
It has to be, you would think. Crazy.
So
what's it based? So it's based on just getting a loan, and they're going to do something. Brian was sort of saying here that a vaccine provider now.
No. At the moment, so Trump's on the warpath at the moment, and since we last spoke, and I said he'd been in the media a lot more, he's almost done an announcement every day. So he's started to act like a president.
Yeah.
Well, he started to do things that a president would do, not act like one. And so one of his initiatives, which is, I guess, in some ways a good initiative, is to secure secure drugs for Americans. And when I say drugs, I don't mean, methamphetamine or anything like that.
Not from Mexico. There's plenty of those already coming in. Yep.
That's all right. He can't compete with the cartel. He knows that. He'll wake up with a horse's head next to him. But so they're just to produce pharmaceuticals for the general population of America, the low-cost pharmaceuticals. So here's the thing: the stock's blown up on the back of a $700 million loan. Okay, fantastic. But now they're in a market to produce in America low-cost drugs for Americans. It's kind of like the drug security of America, because they don't want to be reliant on the rest of the world.
Right.
And so as a result, this is one of his initiatives that he brought in. So an absolute. I was pedaling on the bike, and I nearly fell off the bike, and it's a stationary bike. Right, so I saw this chart, and I'm like, what have I missed? And that's a bit of the lunacy that's going on in the markets at the moment. And Brian, thanks for killing the cliffhanger there. So, mate, that's just a little bit of an interesting anecdote. But that goes to what we've been talking about in earlier sessions. If you relate Kodak to the economies, and you relate stimulus, this is the same sort of effect. They've pumped money into a company, so therefore the company is shot up.
Yeah.
So I guess the other trends that I'll chat about a little bit today, again, is a bit more of gold and silver, but for all of the business owners out there in Victoria. So I'm going to forget about all of you healthy states out there. and I'm just going to focus on the champion state of Victoria. And we always like to make predictions, Jason. So this is my prediction. My prediction is that when we get back to full contact, when we get back to full contact sport, every other state in Australia is fucked, because the Victorians will have so much built up animosity for all of the other states that you guys, it doesn't matter whether it's boxing, football, hell, I reckon if tennis becomes a quasi-contact sport, you won't win a single set. You won't win a rubber for the next decade. That's my prediction there. But for business owners in Victoria,
yeah,
oh yeah, will they? What? For business owners in Victoria, you've got 19 days to get a hold of this little sucker here. So this is another initiative. It's been actually around for a little while, but I forgot to mention it last week. Another business support fund that you can get. I'll drop the link into both Jason and my pages so that you can access it directly. So for the business owners,
Absolutely.
all you need to be is you need to have employees. You need to be registered with WorkSafe, so you need to have your insurance in place, and you need to be on JobKeeper. And if you satisfy those three, you can lodge an application here, as long as you're in the area of lockdown in Melbourne. All right, so 19 days to go. And I venture to say the area of lockdown in Melbourne may increase substantially. So the amount of people who can access this will probably increase substantially. But key things must be registered for goods and services. Obviously, a registered business. Need to have employees, and you need to be with WorkSafe. So it means you need to pay for your workers' compensation insurance. Don't look too far past that, because realistically, it might cost you $200-300, and the prospect is that you'll most probably get the grant for $5,000. And you must be on the government JobKeeper. So if you're on the JobKeeper, then there's another, and you're in lockdown and you hire people, you've got the opportunity. Look, I don't know whether you got the opportunity to get into your WorkSafe, but it didn't take me very long to register up. So I'd imagine you should be able to get your ID number pretty quickly. But if you've got that, then there's some funding that will be able to give you access to an additional $5,000, which is going to help a number of businesses, as long as you're going to put those funds through to good business use, as they will probably.
Yeah, there's a lot of little boosts out there, isn't there, Andy? So there was the $10,000 bounce back. This one. There's a few out there. So for any business owners listening in, reach out to a good accountant, or reach out to Andy or anyone in the planning and accounting space, just to find out, because 10, 20, 30 grand's worth of grants, that can replenish your war chest. It can set you up for expansion. It can take care of things as well. And this is a shout out too for those who are affected by the second lockdown in Melbourne, and people were getting back to work. There is a little bit of talk about potential lockdowns coming back again to other parts of Australia as well. So just a bit of a reminder, gang, that we need to make sure we understand what's going on out there in the marketplace. And certainly for those who have a lease, so business owners, this is a little bit sort of focused on business owners at the moment, but there is a code of conduct that is around for business owners and tenancies of commercial properties, and make sure you understand how that's applied if you are affected by COVID. So I've seen a few things in chat rooms. I've seen a few things here and there about people sort of go, landlord wants to put my rent up. I saw one the other day. Someone tried to put rent up, and the business owners on JobKeeper and it stood down their team for the moment, or on JobKeeper. So the landlord can't do that. So for those who are listening in, if you're feeling pressured by the landlord and you're feeling out of shape, reach out. Myself or Andy can help you as an initial point of support. But certainly, your legal team will know this. Be all over it like a rat up a drain pipe, really, at the end of the day. So there is a code of conduct. If you're on JobKeeper, your turnover's down. The landlord has to give you. They have to. It's legislated now. They have to give you allowances for reduced rent or even no rent for a period of time as well if you can't trade. So, and they can pass that on to the banks as well. So, just understand that one, gang. There is some legislation in place to protect everybody in these times, of uncertainty for sure.
Absolutely, and I think that that my team over here are very happy to hear you say that.
Well, Andy, I think that's pretty impressive. Anyway, we're nerding out here. It's a bit of an in joke, but it's we've got a few questions about the links. Michelle, you and I know each other. I can hit you up with a copy of the code of conduct. So DM me or PM me or whatever it is. What is it? Is it a personal message? Is it a direct message? I don't know. There's so many ways to get in contact with people these days. But happy to share that.
You mix them up from lots of love to laugh out loud, and you can get yourself into a right bloody mess these days. So.
Yeah, no problems at all.
Just on that, mate. The other things is, I know it's good to be on top of the accountants. Not literally, figuratively, of course, but just also be aware that this is your responsibility as business owners if you're out there. So we're posting it in here. Look at it, use it, distribute it through your Facebooks. Like use these platforms that we're all on to distribute information that is going to help people. And but ultimately, it's your responsibility to be doing it. And the reason why I say that is because, mate, as financial professionals, we are absolutely flogged with new legislation, updates, this, that, and the other. It's really, really difficult. That's why we set up these sessions. It's really difficult to stay on top of everything and keep everybody informed. So although, yes, bounce it off your accountants and that, but just have a weekly check on business.vic.gov.au and have a look whether there's any new ones up. If you're in Victoria, do the same thing and log on to the Chamber of Commerce sites because they often have some information that relates to all of these things, because the government almost slide them in. It's the most peculiar thing. They give these.
There's not a lot of promotion about it, is
there? No. But they'll talk about what they've given. They'll go, last quarter we gave businesses the opportunity to take up $10,000, and we were surprised at how few took it up, and it's like, because you didn't say anything about it. People just found it. So let's be on top of it. Yeah, exactly right.
Accidentally. Well, an example. I've got a client. Who's a business owner. I'll give you a quick example of, client, business owner, understood, did a little bit of study and research about they had to shut down because, and I won't say the business, but like a gym, people came and they did an activity in their center and, had fun, and it was a social plus activity center, and they couldn't do that anymore. So, it got completely shut down. And they had 3 of these centres in different states. So basically, their income was zero. They paused their rents on their commercial properties. They paused their personal mortgages. They got on the JobKeeper. They got all the PAYG and the GST and the payroll and all of this support from the government. They applied for the bounce back. They applied for other grants as well. And this is a pretty interesting story. They've ended up putting a huge amount, 6 figures of extra war chest in their bank account in comparison to running normally. And when they were allowed to open back up, they actually used that war chest money to open another centre. So they're not in Victoria, so they're Queensland, Western Australia, and Northern New South Wales. They're actually back at 50% more revenue than they were when COVID shut down. So an opportunity, a strategy for some business owners listening in is to sort of squirrel that war chest and use some of that capital for a bounce back, and we're sort of, encouraging property investors who are affected in that way to use this moment in time in the same way. If you do get mortgage pauses, screw all that cash, make sure you're safe, make sure you're well. But then, if you do end up with a good chunk of cash, then redeploy when the time's right, when you're back at full-time work, when your income's back at, normal, redeploy those dollars and cents back into the marketplace, because, that's what it's for. It's not for you to sort of sit on it and squirrel away for winter. It's for redeployment and sort of, if it benefits the economic system, then awesome. That's the outcome that the government's looking for. So, a little bit of a story there.
But it is for winter though, Jace. When we say that the seasons of stimulus,
yes,
because I've had business owners who've sort of said, look, we don't need it, and when we talk about the cash conversion cycle, so how long does it take to turn lead into revenue, and it's like, well, you haven't been hit yet. And there's a likelihood that you will be hit, but you're going to be hit when all of the stimulus and things are not rolling on. So it's kind of one of those things that take it if you've got it. And then, you know what, there was a beautiful case actually up in Queensland I read about the other day. And gosh, what was it? There was a couple that must have been on, must have got the two lots of $750 each. Right, so they got their $1,500 each, so $3,000 from the government, and they rang up one of the radio stations and said, "We don't want it because we don't need it." So they must have had their house and just getting $1 of age pension or something. And somebody said, "Give it back to the government." It's like, whoa, hey, hang on, so not that quick. That's not the smartest thing that has ever come out of your mouth. But if you want to, give it to some philanthropic cause. If you don't need it and you feel weird about having it because it's a subsidy, use it to deploy and create a benefit out in society somewhere. But ultimately, again, it's the condom theory. It's better to have it and not need it than need it and not have it. So make sure that you're all over this stuff. Yeah.
Well, yeah, and like you said, Andy, if it's winter, you're not redeploying the capital. If it's spring or, and the shoots are green and you want to sort of, put some extra fertilizer into the soil, then, that's the time to redeploy and that sort of stuff. But you don't do it before the crop's blooming and that sort of stuff, So you're dead right, mate. You're dead right. Yeah. Well, some interesting stuff in my neck of the woods, mate. The old tax system when it comes to real estate, at the end of the day, New South Wales and Victoria are proposing to fix stamp duty. I wouldn't concentrate on the word fix. I think it's still a train wreck, no matter which way you cut, you slice or dice this thing. All they're doing is, I think it's a slippery slope. This one, trying to set up. Yeah, I don't know. Was anyone paying attention when they said, "Listen, we'll bring in GST." We'll bring in GST and we'll get rid of stamp duty and we'll get rid of payroll tax.
Keating for 1,000, Jason. But that was a reasonable interpretation.
Oh, it was insane, right? So here we go. We get another tax and the other two stay behind. Australia's tax system is an absolute fucking joke. But, at the end of the day, we live here. It's a safe country, in comparison to other places, I shouldn't complain, but, it's a free country, so I can, so I will. So, at the end of the day, the tax system, I think I did this one last week, Andy, the property investors contribute like billions of tax revenue to the government, in all sorts of crazy ways. But here's an interesting one coming for everyone. Victoria and New South Wales are going to lead the way. What they're proposing on doing is taking away an upfront stamp duty and then doing an annual fee, an annual ongoing trailing fee. So really, at the end of the day, I think, at the end of the day, they should be getting rid of stamp duty completely. It's an absolute farce that, they brought in GST so they could get rid of stamp duty. But now they're saying, 10 years later, when everyone's forgotten that was meant to happen, now they're going to turn it into an annual fee. You extrapolate that as a property investor. over 30, 40, 50 years of ownership. Bloody hell, given the choice, I'll pay the upfront fee. Piss off. I think this thing's a joke. So I'll be watching closely, and I'll probably even campaign against it, which I never thought I'd say. But let's see.
This is for those people who have been watching. I'd be interested to know by a thumbs up whether you think Jason's actually going to start running for local council here, because that is the second political move that I've heard him make in the last couple of weeks there. So throw a couple of thumbs up if you think he's going to run, or whether you would vote for him.
Well, mate, I'm going to book myself a meeting with the local councillor. I can tell you, yeah.
Mate, that's interesting, because and I'm sure you got more to say on it, but just as a quick side note, there's some research that I'm doing at the moment in and around some new legislation that's dropping with regards to testamentary trusts, and I won't go too much into it now because I haven't finished my research, but effectively they're figuring out ways of being able to bring in some tax on these testamentary trusts, which for those who don't know what a testamentary trust is. If I passed away and I left money to my kids, you put it into a testamentary trust for a couple of reasons. First reason is that if a child earns income that is not derived by them working, and they're not allowed to work until they're of age, you get 66.67% tax on the income. I know, crazy. So now we built these testamentary trusts, which allow them to have the same tax thresholds as what we do. They're starting to toy with all of this. So, mate, I'm not a conspiracy theorist, and I don't like to bandy around bullshit, but it's a little bit disturbing, some of this stuff that is starting to pass at the moment. And I think we said it on maybe the third Wine and Wisdom, and what we said is be vigilant in your own industry as to the changes that are happening at state, local, and federal levels, because I think that there seems to be, and now I'm confident enough to say this, there's a lot of stuff that's getting passed now that is just slipping under the radar, even at a local council level. So again, be watching what's happening in your industry. Don't fall asleep at the wheel. Make sure that you're watching what's
absolutely,
going
on. Mate. Part of APRA, and this is quite interesting. You know this one. You're in the financial planning world, right? So, I'm in the mortgage broking world. So, best practice. Best practice. Your client comes first. Conflict of interest. Conflict of interest remuneration. So, get this. Finance brokers. So, mortgage brokers are held to a higher standard than lenders. Lenders are actually outside the legislation that got passed by APRA. And so, right now, they say, all right, well, a mortgage broker has to say to Andy Fenton, Andy, you know what? Westpac's loan is better than NAB's loan. That's what the mortgage broker has to say. It's legislated by law. And if they don't say that, or they don't give their client, but Westpac has no requirement in any way, shape or form to say, NAB's loan's better than ours, guys, you should go get it. How ludicrous is that? Like, it is double standards, and you're dead right. There's collusion at the highest level in this space, and you and I could probably attract some undue attention, if we really went.
Allegedly, I think you were saying allegedly there.
Totally alleged. But part of APRA's legislation actually allows, right now there's some clauses in the legislation that allows the banks to have access to funds changes. So it's the old sort of hello over here. Mortgage brokers shouldn't get trail. They decided to say, oh, mortgage brokers are crooks because, they're getting trail and they don't do any work for it. What a bunch of rubbish. Mortgage brokers work way harder than your frigging bank do. I can tell you that. And any mortgage broker worth their salt will attest to that one as well, at the end of the day. So it's an interesting one, Andy, when you bring it up. In our world, there are large organizations with, significant resources that anytime, aware people say, no, you know what, I think I prefer to manage my own money, because AMP is not doing such a great job of it, or no, listen, I want another choice other than Westpac, or a combination of that. There is actually some quite significant, fear and bullying by government bodies, ASIC and other ones, APRA and so on, saying, "Nah, Andy, you're too dumb, you're too stupid, you can't manage your own money, you've got to leave it up to professionals," which I think is absolutely reprehensible. It's just disgusting, but anyway, mate, this is the stuff that we play. You and I help people who actually want to manage and control their own future, because you said it before, we're responsible for our own future. Sort of, don't sit there and come age 70, complain that, oh shit, the government ripped me off, or I didn't know. Yes, you do know. We all know. Ask these questions right now. What are we going to do to make a change? How do we get more responsibility and manage our wealth? Whether you're a property investor, whether you're a business owner, sometimes we don't want to. We're like, oh shit, that seems pretty heavy. But at the end of the day, it's up to us. That's the reality of it, isn't it?
100%, absolutely. Absolutely, mate. No true words spoken, allegedly.
But you know what? It's an interesting one, Andy. It's an interesting one. I did a bit of a Facebook Live today on this, and you brought it up as well just now with the testamentary trusts. There's lots of questions, lots of uncertainty in the world of, how do I own my assets? And it's horses for courses, and it's, do you want the benefit now? Do you want the benefit in the future? Is it protection? Is it lending? Is it tax minimization? Is it passing on those assets? Mate, I know there was a couple of people on my live this morning, on the call tonight. Mate, from your professional opinion, it's not one size fits all, right? You've been in this game, a lot of people, is complicated, right?
Oh, definitely no one size fits all. Just in the last 2 days, I've had some fantastic conversations actually in and around these sorts of things, and it depends on whether you're a business owner, whether you're a salaried employee, where the future, what the purpose of the asset is, and anybody with a one size fits all approach. You don't have a one size fits all approach, do you, Jace? Okay, cool.
No,
so anybody with a one size fits all approach is probably to a degree full of shit.
I agree. Yeah,
because it's not possible. You can have themes that suit different clients, but from a structural perspective, and it's so dangerous, and especially now we're starting to see it, because it doesn't work until you start questioning it, right? And there hasn't been right now. People are questioning everything with a higher degree of scrutiny than what they have over the last 10 years, and so people are starting to go, well, fuck, I'm in a trust, and now all of a sudden I don't get any of these benefits, and or I'm in a company and I can't sell. So, in some ways, it's actually quite simple, and you've seen me do a few presentations on this stuff, and I know that there is, and I fundamentally know it's true because I'm not that smart. I'm no lawyer. I'm no freaking genius. And I've been able to teach my niece these sort of concepts pretty easily as well in regards to trusts and companies. But people switch off because you use words like constitution or and this secret sort of language. But when people start to actually relate simple terms like this is the coach, this is the, this is your back line, or relate it to a terminology that you understand, it's actually not all that difficult. But right now, we're shifting people out of the incorrect asset structures left, right, and centre. And it's because people are starting to ask the question, and then when they ask the question, the answer is not forthcoming. And the reason why the answer is not forthcoming is because it's the wrong structure.
Yeah, yeah. I mean, in my world, we've got, there's a couple of, operators out there who like to sell sort of, fear that you're going to be sued and you're going to lose everything, and the only way to protect yourself is companies and trust structures. And at the end of the day, unfortunately, I've been in a few scraps in my life of property investing for 22 years and in business for 17. And, at the end of the day, if you do something wrong, or even if you don't do anything wrong, even if someone else says you did something wrong and you don't believe you did, there's no protection from a company and a trust. It's bullshit. At the end of the day, if someone wants to have a crack at something, it can cost you money, it can cost you time, there's risk. And for a PAYG, one of the things that really grills me, gets in my goat, is you get, a couple of investors, mum and dad investor, they're sort of starting out, they're buying their first investment property, or, maybe they're buying their first set of shares or their first fund, Andy, and then, an accountant says, oh, no, you've got to set up a company and a trust, to buy your first property, which is, $3,000 to $5,000 later, plus annual returns and annual accounting for what? Like, $5,000 worth of shares, or, a $300,000 or $400,000 investment property. That really goats me, because like, I personally don't think that most people in the PAYG space need that type of protection unless there's some real reason in that space. And you can be tax effective now. There is some disadvantages later from a passing on assets and those sorts of things. And you and I have talked about this. We've got some strategies. One of the most amazing strategies you've shared is like the idea of buying something now to then transfer in the correct way with the right strategy into potentially a super fund into the future. I love that strategy that you deploy for some of our clients, where it's appropriate, so yeah, just talking through that today. I was doing a little bit of a live on it, and there was a lot of comments come up, and there's a lot of confusion, and probably my point is that, a lot of people give away some power, in this space to professionals who then end up sort of put them in, structures that are really inappropriate, So I don't know. Can you talk to something like that, Andy? Like, not giving it any advice, obviously, because you don't know anyone's circumstances. No. Yeah.
Love it. No. And my philosophy is pretty key on this. And for business owners watching this, fucking hell, the accountants are going to have a bit of a run on some more questions when they're already under the pump. But you've got to be able, before you go into a structure, you've got to be able to articulate to yourself and your partner, if you've got one, or one of your family members, the reason why you're in the trust. And then work it through logically, because blind advice is bad advice, and that doesn't matter what field that you're in, right? Like, and you don't have to be technical, but you have to understand why. That's it. It's as clear as that. And if the person who's telling you to get into a structure can't explain the reasons why to a point where it resonates logically through to you, then no, you keep researching, and that's fundamentally it. And the question why needs to be a considered one, not just it's for asset protection. Okay, yeah, that makes sense, because nobody can protect it. You go, well, what as a salaried employee, am I going to ever start up my own business? No, hell no. I wouldn't be psychotic enough to start up my own business. Okay, cool. Question number 2, and fair call at that, right? So then question number 2. How often do you get drunk and drive down the street with the intention of hitting a pedestrian? Well, Andy, I don't even drink. Okay, so there's a very, very short chance that you're going to do something highly illegal that if you do it, then your assets could be come under fire. No, I don't even drink. Okay, number two, then it's like, well, why do you need the protection? Just in case somebody sues me. Okay, so who would sue you? So it's just digging a little bit deeper into the why to everything. To minimize tax. Okay, well, why is it helping me minimize tax as a company? Well, if I'm in a company, yes, you'll isolate the 30% tax rate. What's my current tax rate? It's 33%. Well, is it worth it for 3%? It's literally, when somebody says this is the reason, just explore it and ask why, and apply it to your circumstance, and then look at yourself in the future and say, well, is that relevant to who I'm going to be? And of course, like, you might develop some sort of psychotic nature and want to become a business owner at some point in time in the future. Well, okay, so that it happens. I've always said that the best protection that anybody can ever have is an incredible relationship with their partner, whether it be straight or gay.
Mate, and I can back that one up. Number one financial disaster in the average Australian's life, or the unfortunate average Australian's life, is divorce. Number one. How about this? When you buy assets, you should go on a relationship course. There's a tip for you. Don't worry about setting up a stupid company and trust. Go and do a relationship course.
It's fairly true. But then, if you look at that further forward,
number one, then, the family court will drive through any structure known to man in Australia. So, number two, if you break the law, Andy, like your example is, you drive down the street over the legal limit of alcohol, and there's an accident and something happens terribly, no company or trust will protect you in any way, shape, or form from that. Like, it's absolute bullshit with a capital B. At the end of the day, I say to property investors, and you might be able to sort of speak to investors, in the stock market and other ways. The best protection for a property investor is, number one, insurance. Get the best insurers possible. There's 2 or 3 in the market that are fantastic. An amazing property manager. Don't this all the time. Who remembers purple bricks? Anyone remember that? They just meant friggin' broke. Have you heard it? Like,
sorry,
did you say?
You said you broke up a little bit there. Did you say purple pricks?
No, purple bricks.
Oh, purple bricks. I was wondering where the hell you were going with it.
No, there was a budget, real estate property for $5,000, right? Which, sounds fine, but at the end of the day, they went broke. Like, and in property management, people skimp on property management. Oh, I'll get my property management for 4% or 5% or whatever it is. I mean, at the end of the day, guys, seriously, pay your property manager some extra to do the right job, for crying out loud. At the end of the day, that's like do the math. It's like $3. So at the end of the day, it's not a lot. Get insurance, pay the right money. Get a good property manager. And, if you really feel as a PAYG owner that you have some risk that you want to protect, there are very easy lending structures, personal lending structures, where you can put unregistered second mortgages over your properties that can protect the equity in there. Because I can tell you, the only way anyone will ever sue you is if they see the difference between the mortgage and what the property is worth. Because I can tell you, unfortunately, I know a few lawyers, and I've sat across the table from them. And maybe we should one day, Andy, interview, and you can't judge these guys, because these people are just who they are, right? And you go, well, what, as a lawyer, what, how do you decide to sue somebody? And they go, well, you know what I do? I jump on I jump on this website and I search their assets, and then I go to the mortgage registry and I see the difference between what it's worth to them or not. Like at the end of the day. Anyway, I don't know. We're off track here or on track. I don't know. This is a good conversation or not. We're getting a few. Comments.
We've got a couple of questions in here, and we've got a few comments as well from good old Jason saying, "Yeah, pay peanuts, get monkeys." That's 100% true.
That's it.
Or sometimes pay peanuts and get a rare gem, but they're rare. You know, they don't know their own worth yet.
Long, Andy. They won't last. This is the thing, unfortunately. You know, and it's a really interesting bit of psychology. You want your advisors to be extremely wealthy and extremely successful. You don't want them to be living on a fucking budget. Seriously. If they can't get by, gang, they're not going to get by. At the end of the day, your property managers have got to be great at what they do. They've got to be the best. They've got to be in the top 1% of their industry. That doesn't mean charging you the least in their industry. Matter of fact, it's going to be charging you the most, but you're going to get the best out of them. And that's a really interesting thing. Like, and I talk to this every now and then about the psychology of money and wealth. There is no value in skimping and being a miser in wealth, Andy. It's an interesting one. You're looking around for always look for great value. No issues. Always look for great value in a deal. But in a service, look for the result. Look for the value you get for the investment. Don't look for the price. The price is a poor measurement of the quality or the value you get, at the end of the day. So, it's an interesting one. It's an interesting one in that sort of space. But anyway, I'm ranting on about property managers. I say pay them extra bucks. Yeah.
Did you just buy a property management company? Just joking.
No, I did actually. Yeah. Pay them more.
And now we know the veil is clear. So got one from Harry.
Christopher, we do see your comments, Christopher. We were about to get to them.
So got one here from Harry, mate. He's gone, Jason, would you recommend property investing in positive cash flow or capital growth with consideration with everything that's going on in the economy right now?
Certainly for me, I would hedge my bets. I've said this many times before. I think capital growth is a vanity metric, Andy. It's a vanity metric, number one. And number two, you have no control over that one, right? Like what do you know? Like, does anybody know what the capital growth of your property is going to be next year or the year after? Right. Today, what we can do is we can analyze the cash flow and the interest rate and the costs of your property, and your cash flow today. So at the end of the day, what I would do, depending on what you need as a property investor, I would be investing for an appropriate rental return with a property that is located in excellent proximity to fantastic infrastructure for the future. And I would be betting on the infrastructure and what I call a proximity for profit for a property. I'm not calling it capital growth because I have no idea when that's going to occur, but the holding property is going to be positive in my pocket, and the location of that property is going to be fantastic for the future. Now, it might grow in 1 year, it might grow in 10 years, but I don't care. When you have a problem that your property didn't grow in 1 year, you have an ego reaction to you being right or wrong, and that's a terrible way to be an investor. Terrible way to be an investor. Because for me, you purchase a property in a fabulous location for the longer term. Capital growth comes over time. Capital income is instant. Tax deductions are instant. And those are the two things you can kind of really lock down as a property investor. So that would be my feedback for Harry. I would invest for certainty for right now, certainty of income, certainty of position, and then possibility of capital growth. Like there's no certainty of capital growth in the short term, but certainly long term, if you next to the train station, the hospital, the city, infrastructure, shops, all of those things, certainly 10, 15 years, there's a high level of certainty for growth in that period, but not in the short term.
Yeah, it's an interesting one from an interest rate perspective as well. With long-term low interest rate, you would imagine, and this is really just a question phrased as a statement. You would imagine that given longer-term lower interest rates, there'd have to be some sort of equilibrium that'll work out in the market over the next 2 to 3 years. And obviously that arbitrage kind of happens reasonably quickly, but we must be going into a period of consolidated yield and consolidated capital growth. Probably not right now, because I think that when there's pain in markets, there's certainly going to be some cracking opportunities. And I think the longer that this goes on in Melbourne, there's going to be some real incredible opportunities, but that arbitrage is going to happen quickly, and you got to have your finger on the pulse, and you got to be in the know, and you got to be ready and Johnny on the money with the cash. Once that plays through, there'd have to be some sort of longer term metrics in order to be able to go, okay, well, when was a point in time in history where interest rates were super stable for a really long period of time? I'm not sure if it exists. And as a result, what happened, and I'm thinking from an equities perspective as well.
Yeah, I reckon we're going to see, I personally feel from everything that I've been learning from my contacts, and you might have some feedback on this as well, we're in for 7 years, pretty well the same for the next 5 to 7 years. Like that's what we're seeing, with my feedback from lenders, private lenders and public lenders as well, and what happens in times in real estate times like this, like I've done, sort of cycles like this twice now. What you can purchase for and it's an old adage, location, but there's a better word for it, which is proximity to, which means next to the right school, the right train station, the right hospital, the right shopping center, the right, neighborhood, the right. Like, it's what you can do in times like this is you can migrate your dollar, your buying power, from 10, 15, 20 kilometers away from a proximity purchase, and you can get it closer to the most awesome things. And when the market returns back to sort of regular pressures, whatever that looks like into the future, your market, that ripple effect, the things that are closest to the proximity profit centers are going to get the uplift first. They're going to get the rent uplift first. They're going to get the capital value uplift first, and so on, So, a house 20K from the CBD or 3K from the CBD, far out, you'd back the 3K from the CBD every day of the week, or next to the hospital, next to the uni, next to the private school, next to the, the water, next to the beach, next to the, infrastructure is super important for lots of different demographics, whatever they are, understand them and use them as your temperature test, your temperature gauge for those decisions for proximity.
Well, it's going to be an inflation thing too, right? Because if we look where we're sitting right now, basically 0% Fed rates across basically globally, right? So money is cheap, and the governments will only raise interest rates when they see real live inflation. And so to simplify that, when the cost of your life increases, that's when the governments will start to look at raising rates. So the cost of property escalates, the cost of wine goes up, the cost of the internet, the cost of power, the cost of the basket of goods it's called CPI for those of you geeks out there. But what'll end up taking off is that if you're looking for, and I'm just thinking off the top of my head right now, but if you're, and I haven't considered this previously, but from a property perspective, if you're getting good yield, if inflation if inflation, and it's really when inflation kicks off, well, properties will be a part of that inflation. A good yielding property, you would imagine, would have the inflationary aspects to it as well. And that's when you're going to see yields drop, right? Because yields drop ultimately because interest rates tend to go up. And what I do know about property is that there's this cycle of it's cheaper to buy than rent, and then it is so much cheaper to rent than buy. And these things swing heavily in the opposite directions to each other at times. And so I guess just from an economics perspective, to answer Harry's question from my side, without having any property knowledge really at all from a resi perspective, like if you've got nominal interest rates at a very, very low rate for a reasonably long time, and you're looking at yield, well, as inflation kicks in, all other things being equal, you should be getting the capital growth. But with interest rates fixed at a very low rate, then capital growth, if I apply financial markets to property, capital growth should actually suppress for a period of time outside of, I got into this area and it just happened to become the trendiest place in the world, right? And then it shot up in value because everyone wanted to be there. But across the board, you should actually see a little bit more of a suppression of capital growth of assets and be more of a yield play, because interest rates aren't bouncing around and going based on market mechanics. They're actually staying low in order to try and get markets back. I don't know, just 100%. How I'm thinking, because equity markets work that same way.
Yeah, no, I agree, mate. So, like I think I've said this a couple of times in the last couple of catch-ups we've had, interest rates are so low now the property stands on its own 2 feet and on its own merits. There's no artificial inflation for the property right now itself. Interest rates don't go down. You earn the same amount. Let's say you're on $100,000. Interest rates go down. Your ability to purchase a property, if your interest rate went down 1%, your ability to purchase property on 100 grand went from 500 to 600,000. That had nothing to do with, that had zero to do with the property, the area, the whatever. Your capacity just went up. So what happens? It's financial human behavior. Andy, you can afford 600, not 500. What happens? What does the market do immediately when it understands that? You see it in the stock market all the time. Equilibrium. Like boom, boom, boom. And it only takes months.
We saw it with Kodak. Kodak, it took 2 days. 15,000% increase.
There you go. So right now, exactly what you just said. The only reason property values will outperform just sort of regular market growth, whatever that's going to be, will be because that property is amazing. And everyone wants to live there. That area is amazing and everyone wants to live there. And this is where, my business partner, Sam Saggers, is an absolute fucking genius in this space. He's been talking about this for years. He's been calling it the flight to quality in the world of real estate, because the last decade, let's face it, from my point of view, 99% of real estate that has been built has been absolute fucking rubbish. Just cheap box shit, right? And where's that 1% of real estate that's not ludicrously priced that people would love to live in, and that's where sort of, our sort of theory has matured over the years, which is basically, it's not the bottom end, it's certainly not the top end, but there is good quality, flight to quality real estate, that if you understand a little bit of the dynamics of, living, like it's what Sam calls the 4X factor of real estate, which is, like human behavior. Like, we want to live in nice places and we'll pay extra for something special. What does that look like in real estate? So, we've sort of swung a bit to real estate.
Into that lifestyle, more and more into that lifestyle with COVID, with generations coming through. And I've seen some of the stuff that some of your developers or your mates have done in Queensland, which is really that lifestyle type thing, big ceilings, big rooms, places that you can really enjoy. And one of the things that I've seen in the property side of the equation now for a number of years, and I reckon this is a great article you should write, mate. And you can steal this. I haven't copyrighted it yet. The bubble box creates the Bronx of the future. And what I mean is that when we end up in skyrocketing property prices, and so there's two examples I'll give you this of South Bank in Melbourne. The developers went berserk and created these tiny little bubble boxes, right? How can we squeeze less area into this space and still sell it for a premium price? And they also did it in the southeast of Perth. And for the Perthians around there, it's been a long time since I've been out there. And so I'm not sure if it's the Bronx yet, but I picked it as being the Bronx because it was sort of the concrete jungle of the future. But as you go south towards sort of Bunbury and you get out about 45 minutes from Perth, you see sort of house and land, but like there's no land. Literally the gutters in a heavy rain would overflow into each other. You couldn't squeeze a part out and not be heard by your neighbour. And these things actually, just before the GFC, I remember it was pitched, and I was working with an investment bank at the time, and they were being pitched this company, and they wanted to list it, and they were boasting 38% year-on-year returns, and it was like, ooh, okay, let's go out and have a look at this. And I remember as we were going along, they were all really impressed. I remember looking at it. And what it made me think of was all of those old American gangster movies that you see of the people who are brought up in the Bronx, and it was just a modern Bronx building, and that's exactly what they did. Is they decreased the usable space to the bare minimum, and then just instead of, this wasn't high rise, this was just spread. And, that is always going to be maybe short-term win, long-term pain, as opposed to actually that extra price, get that extra quality, that extra space, that usable land. Longer term, that's going to promote more a usable neighbourhood.
Mate, it's something that decreases. So the size of the property decreased, but the price stays the same. So let's call it $500,000. So, psychologically, $500,000 is the number, but to keep continuing to produce that, they go from an 80 square meters to a 75 square meters to a 60 square meters to a 65 square, and now it's like 48 square meters, and even getting smaller. So they haven't. So the list price hasn't gotten any larger, and everyone's going, oh, the price hasn't gone up. But when you have a look at the per square meter rate that they're producing, let's say an apartment for, or a per square meter rate of a piece of land, and you're talking about that as well. Southeast Queensland right now. A prime example, a place where we absolutely were very bullish about a land location, which is a place called Pollara. The average block size has gone from, 450 square meters down to 350 square meters, So those sorts of things, from a property point of view, certainly take an effect, If you disappeared on me, Andy, is it my internet or yours? I think, well, gang, Andy looks like he's dropped off the face of the earth. It's 6:15, so it's probably a good time to maybe call it a night. It's been good to have a chat tonight. Hopefully everyone has gotten some value. Thanks, Emily. Thanks, Michelle. Thanks, Jace. Thanks, Christopher. Thanks all of you guys.
Sorry, mate, I kicked my power board and everything went haywire on me.
Well, mate, I was just about to wind up anyway, mate. So I was just
just before we do, let me ask you a question, and let's throw out another challenge to the audience. So I'll ask you the question. Anybody, we'd love to see your responses. What's the difference right now between Facebook and Google?
As in the price difference or the value difference?
Well, I'll give you a hint. So two major things happened just last 2 days. As a matter of fact, all of the major tech companies were put under the spotlight of Congress, and basically what we have in Australia, ACCC rules, right? So there was Bezos, there was Tim Cook, Tim Cook from Apple.
Tim Cook, yeah. Apple.
Jeff Bezos, Tim Cook.
Talking about Apple?
Yep. There was Mark Zuckerberg, and there was the CEO of Google. But it's a really, really interesting. It's a really, really interesting space because, well, Apple, talk about just strength to strength to strength, right? So this is Apple, right? This was Apple when I started my bike ride this morning, and then about 15-20 minutes later, that was Apple. So it soared on the back of their revenue report. So their third quarter revenue was 59 billion, right, for the quarter, 59 billion from the quarter, and the expectations were it's meant to be 52 billion. But that's got nothing to do with
59 billion for the quarter.
59 billion for the quarter. In the middle of a global pandemic. Everything
that's
was
fantastic.
App sales.
I think I added about 10 grand worth of that. I think I bought 15 iPads and 4 new computers because the government said, "All right, everybody, buy some new stuff."
Which is a really, really good point, and something actually sort of beating it to the punchline a little bit there.
Yeah.
But literally, it went from 2% up to 3.9% up in about 5 minutes worth of trade. But the difference between Google and Apple, right? So Alphabet, which is Google, its revenue growth literally fell for the first time ever. First time ever is revenue growth actually came back. Well, first time, in the more recent future, right? So if I ask you that, what do you think the difference between Google and Apple were? So I'm waiting for our audience to respond. Come on, guys, this is the time to think quick. There's no right answers. There's no wrong answers. Well, actually, there is wrong answers. But come on, let's see a few. Where's Brian? Is Brian still there? Have you got this one, Brian? Come on, throw it at us, Brian. I know you're still listening.
Well, mate, I think our internet's bloody failing us, Andy. I think we need NBN to sharpen up.
Yeah. So it's kind of the difference between. Yeah, it's not the difference between Facebook and Google. So this is interesting because this is a trend thing, right? So Facebook revenue up 11%. 11%, while Google's revenue was down for the quarter by 8%. So what's the difference between the two of them, given that Google's main revenue is actually generated from ads?
Oh, Brian
So,
Brian reckons the difference between hardware and software, Andy. Is Brian still here?
It is wrong. So there is a wrong answer.
Oh. Do I give
But it was a good crack, and at least Brian's playing with us. You know, I enjoy that. Thank you, Brian. We like a bit of feedback, and so the reason why I wanted to bring this up is for business owners and for thought patterns, and also for thinking moving forward, right? Because this for me was an incredibly strong theme as an investor, as a business owner, and just as a person, right? It's about looking at where the opportunities are. So everybody obviously jumped onto Facebook and TikTok and all of these different channels with global shutdowns and pandemics and more people at home. So the ad platforms that were present on those different platforms, so Facebook ads, for Instagram ads, for all of these social ads went through the roof, right? But Google isn't a social company. That's the difference, right? Google is not a social company, although they do ads. They're a search company more so than anything else, amongst other G Suite. They compete with multiple other players, right? Hardware, software, so Brian was right in that. But really where they get the majority of their revenue is for ads. So if I asked you this, Jason, I said, well, Facebook's up 11%, Google's down 8%. As an entrepreneur, what would you be thinking if you were looking at spending money on ads?
Mate, you know, it might be worth circling back around to Google and having a look at the price, because I can tell you right now, as an entrepreneur spending money on ads, my Facebook expenses have gone up. And I'm like, all right, team, where shall we redeploy some of our capital? Because Facebook is starting to become expensive for our front end delivery, you know?
And that's exactly right. So the opportunities are now starting to come up. I hear on the grapevine that YouTube ads are extraordinarily cheap right now. And so here's the thing: the focus will go where the focus goes. And what I mean by that is where companies and businesses and advertising agents, where they start to focus the dollars, is where our attention will start to go. Like it or not, they figure out beautiful ways of being able to capture us. And I just thought it was a beautiful little observation of the tech companies, in that while we're going through this type of period in time and we're looking at things that are adverse, you know, and we're going, okay, that's a bad place to be because that's not performing well. It's a really great idea to kind of go, well, you know what, the world is arbitraging so quickly now, in that things come back to equilibrium really, really quick. So where you think that something is down, perhaps flip the thinking and say, well, where's the opportunity sitting in this? You know, where's the opportunity? Because the chances are, if it's down and it's good, it's going to bounce back up, whether it be property, whether it be your business, whether it be your business clients, whether it be your psychology, whether it be your family. I think that no matter where you look, it's a truism. And I think that it's something to be mindful of, and it's demonstrated by the two biggest companies in the world. And I think it's represented at a life level for each and every one of us.
Mate, I think that's a perfect segue to call this evening to a close. Mate, it's been an excellent conversation with you. Hopefully everyone listening has been enjoying it. I've certainly enjoyed the chat tonight, brother. So hopefully we've added some value for everyone listening in. There was a few questions there, a couple of technical ones. Gang, I certainly will reach out and answer those on the chat. But Andy, mate, thanks again. Yep, Alison added some value. The one who adapts will win, you know, and I think that's a good theme, certainly for you know, these times. Adaptation is important. So, mate, here's to you, and here's to everyone else, and we'll go. Awesome. All right, gang. Well, hey, thanks for dialing in. We've had fun. Hopefully you have too. And hopefully you've learned something also. Brian, Jason, Alison, Vivian, all of you guys, Michelle, Christopher, all of you guys, thanks for being good sports on my end and chucking questions in the chat. I know you had a few at your end, Andy. So thanks to everyone for dialing in. And you guys have an awesome weekend. And we'll see you next Friday for a bit of wine and wisdom. Take care, everyone. Have a good one.
See you guys. Great weekend.